good time to bring in James Knightley, who's the Chief International Economist, joining in from ING. Thanks a lot, James, for joining in. There is so much back and forth that takes place from Donald Trump. What do you make of the latest comments, and how much weightage would you add to that? Could there finally be some trade deal that would come by between India as well as the US?
Yeah, I mean, it's as we've realised with Donald Trump, nothing is ever set in stone, and things are always capable of moving. China was in the headlines on Friday. Today, it's India as well. So, things can constantly move. Hopefully, there is an agreement, and that can be mutually beneficial and positive for growth on both sides.
James, hi, morning. This is Rima here. Or is it night for you?
It is nice, yes.
It's nice. So thank you very much for joining us. So the next FOMC meet is 29th October. Now, considering that the US government shutdown has extended itself into the third week and we're not getting any economic data points, what does this mean for expectations of a rate cut from the Fed in the October meeting?
Yeah, as you say, the government shutdown, one of the big fallouts from that is that most of the statisticians have been sent home. They're not receiving pay either at the moment, so they're being furloughed. We do have big gaps in our knowledge as to what's going on. So we're having to fill those gaps with private sector surveys. But also, we've got to remember that the Federal Reserve themselves are not subject to the government shutdown. They are separately funded. And they still are producing data. And we had that my time today from the Beige Book. And this is an anecdotal survey of the state of the US economy. And it's really, really important. The Fed puts a lot of weight on this because they themselves collate it. They go around asking trusted contacts what's going on in the US economy. So employers' federations, trade federations, companies and trade unions, all those sorts of things. So they've got a pretty good idea of what's going on. And unfortunately, it wasn't particularly good today. There was indications of more loss of economic momentum, more weakness in the jobs market as well. And following on from Jay Powell's speech yesterday in Philadelphia, where he suggested there's no sign of real improvement since the last FOMC meeting in September. And at that meeting, they themselves were forecasting 2 more rate cuts this year. I think there is still enough evidence out there, even though with the government shutdown, even with the lack of official data, to trigger another rate cut in October. And we think also another rate cut in December as well.
Okay, all right. Hi, James. Morning. Always good to speak to you. How are you reading the US economy, though? One would have thought they would be in a little bit of trouble with the kind of global uncertainty with regard to what Trump has to say and those tariffs as well. But it appears earnings are pretty okay out there. And the economy as well keeps climbing any kind of wall of worry, so to call it. Your reading of the US economy?
Yeah, so at the moment, I think pretty much everyone is looking for these 2 rate cuts this year in October and December. The Fed are forecasting it, the markets are pricing it, economists are also saying that that's what they believe. But for next year, it's a little bit more diverse in terms of the thinking out there. Now, the positive spin on the US economy is that, well, looser financial conditions from Fed rate cuts, lower treasury yields, a weaker dollar, that's all pretty growth supportive. And if we do finally get clarity on trade, things settle down, that may start to boost sentiment, may start to encourage companies that have been a little bit anxious to start putting money to work, starting to invest, starting to hire once again. And that would mean perhaps the Fed don't need to do all that much more and the economy can recover quite nicely. But there is a negative scenario as well, whereby the trade tariffs do start to bite. We do see squeezed spending power in America. We do see squeezed corporate profit margins in America. And at the same time, we've got to acknowledge that the jobs market is weakening. That momentum could continue for another few months or so. And that really undermines consumer confidence. And in the United States, consumer spending is 70% of economic activity. And then thirdly, the other risk is the housing market. We have seen 5 consecutive monthly price falls in property prices. And that's another important store of household wealth. And that could yet undermine that growth story. So you're getting a diverse range of views. You're getting the upbeat view where we may only need 1 more rate cut next year. But there's also a downbeat scenario where we could see the Fed need to move into stimulative territory and actually cut rates perhaps 100 basis points next year. So you are seeing that sort of split. We're somewhere in the middle. We're cautiously optimistic, but we do think it's probably going to take more than 1 rate cut to turn things around. We think we are looking for 2 this year and at least another 2 rate cuts next year.
All right, James, no conversation is complete nowadays without talking about the view on gold. and we focus on the equity markets, but the big move really has come both on gold as well as Bitcoin. And one would have thought, the investors approaching both these two asset classes are very, very different. But how do you read gold going ahead? 50% up in a single year. Has it run its course? Or do you think central bank buying, ETF flows as well picking up, and those rate cuts as well normally bode well? Your view on gold?
Yeah, I mean, you can look at most risk asset classes, and you could say, well, they've had a fantastic run. Are they in line with economic fundamentals, or are they becoming somewhat detached? I'm going to have to stick with the Economists Union and quote John Maynard Keynes at you and say, markets can remain irrational longer than I can remain solvent. Yeah, it certainly could go higher, and there's at the moment very little to trigger something that might lead that to correct, even if you do fundamentally think, well, we've had a long run, can this really continue? We're in these sorts of frothy markets right now where anything could happen. And I do get a sense that volatility is something that is really going to be picking up as the risk environment evolves over coming months.
So amidst all of this, what would your view on some of the emerging markets be? And given the underperformance of India, would you see that turning at any point in the very near future?
I think we need a bit more clarity, don't we? And, if we can get trade situation resolved and the energy situation in India resolved as well, a mutually beneficial deal, then that can be a platform for opportunity and a platform for growth. But as long as there's uncertainty, there's always going to be these nagging doubts about what's out there, and that just makes consumers and businesses cautious. So a bit more clarity on where we're heading, and that can actually allow a bit of stabilization and room for improvement in an environment where we have got looser financial conditions, as I already mentioned.
James, great chatting with you. Thank you very much for joining us.